Alright guys, hope everyone's doing well. So I wanted to give an example of an example of scaling in, and I never normally do this, but on this example I will. And again, I'm still not going to talk about how I'm doing day-to-day trading. I'm only showing this simply because this was a simulated trade. I purposely took this trade on simulated just to show an example of a scale-in trade. Now, I'm mainly trading the spider right now, but I did this trade as an example, again on a simulated account. So although it was not technically a real trade, it's an example of how one should scale in. And to keep it really simple, for those of you who have not, if you've never watched Al's course, I would highly recommend getting Al's video course. It's phenomenal, and that's just his old course that I'm talking about. However, if you've watched his old course, if you have his old course, then you can see his parts of his new course, his example slides. He talks a lot. He does a really good job on the new slides. They're very clear. And again, I may not talk so loud just because it's late at night. So sorry if my voice changes here and there. But again, here's kind of an example Al talks about with scaling in. And this is one of the reasons why scaling in can be so difficult for traders who are trading small. See, if you can trade small and scale in multiple times, you have a huge advantage. So let me run you through this trade real quick. And again, this was a simulated trade. Once again, this is not normally the way I trade on a day-to-day basis, and I'm only showing this simply because I wanted to give an example of if I was going to scale in, how I would do it. So let's begin. So real quick, I'll explain what these dots mean in a second. But real quick, let's just kind of walk you through what was going on at this moment. So prior to the trade, my thought was, spike pullback channel, so bottom of some sort of trading range, and we broke below it fairly strong. And my initial thought was I was looking to buy, but I wanted to see. Then we got this breakout below, and I knew I sold this close, and I knew if I sold this close, we could potentially have a really deep pullback. But I was also very confident that as long as the rally wasn't really too strong, we would retest this low. So sold at, let's go back to here. I sold one contract here, and again, this was simulated, but I'm just showing its proof point. That's the reason why I did this trade. Sold one here, and I put my stop all the way up here, just way up here. No intention of letting it get hit, but catastrophic stop. And as you can see, short at 19.5, so that's this close. Then I sold another contract. It's 2 points higher at 21.5. So here's 21.19.5. Here's 21.21.5. So 2 points higher. Again, stop up here. And when I did that, my original premise was to get out of break even on this close. Tight enough channel, I thought, yeah, we'll probably get a second leg. We may go up here. So I'll keep my stop up here, and as long as my premise doesn't change, I'll stay in the trade. So I had a first one position here, so 25% position here, another 25% position here, and my next thought was I'm going to scale in either at 50% or below a bear bar close to 50%. So that basically means I was going to sell one contract, and two contracts somewhere up here. Now, so let me quickly run you through that. So sold one here, and actually ended up selling two up here. And if I wouldn't have, I said it here, if I would not have been technically filled, I would have sold below this bar. Or worst case, I want to stop below here. So if we think about that, if you do the math, sell here, sell 2 points, sell 2 up here, you get you about 10 points total on the trade. So it's roughly 500. Now, $500. Again, this was simulated, so I'll show trades like this here and there. I might purposely take certain simulated trades just to prove a point, or just for an example. But again, please don't ask me personally how I'm doing or certain trades. That's not something I ever intended of getting into. I just like talking about trading, and if I can help someone in some way, then great. If you really want to learn how to trade, follow Al Brooks. If you look on my YouTube channel, I reference him plenty of times. I reference his websites. Follow him. Don't follow me. Just use me as a quick, reference. Because that's really all I want to be right now. But anyways, enough about that. Let's break down the math. So when I was in 4 contracts, my stop is 1 tick above this bar, this high. Well, that's roughly $1,400 of risk. My target was down here at about $450 profit. Well, let's do the math. So that's a little more than, it's about 3.1 times my normal risk. So what does that mean? That means I have to be over 70% right to be break even. And that's why with scaling in, you need to trade small. Because here's why most people screw up. They say they'll scale in, they'll use a stop somewhere around here, maybe here, but they won't use the right stop. And they'll scale in right here and say, oh my gosh, I can't take the pain, and they'll get out above this bar. And they'll get out right at the high and watch it turn down. So, here's another example. This is the good example. Sell this close. Well, if you sell this close, there's really only one good way to do it, because up here's a target. So you need to stop somewhere up here. So it's 2141.75 to, that's 15, 17 points. So it's almost not even worth it. A better example is, sell this close, stop up here. Sell 1 point, maybe you sell this high, and then you sell 50%, get out of break even. So there's a huge advantage. My favorite way to scale in with the trend is to sell 1 or 2 points higher, and then double my position. So 25%, 25%, and double my position around 50% pullback or below a good second entry short. Again, if you get Al's video course, if you've already purchased Al video's course from the past, you have access to his new parts of his new course. There's no recordings, but the PowerPoints are done, and they are very, very excellent. So, you can watch the video over scaling in for more information on that. But yeah, so you can see what happened. Price came down, got out of break even, and price turned up. Now, I'm going to go ahead and I'm going to get rid of this just so we can look at the bars. But as you can see, this move up was rather weak. Sure, it looked strong here, but again, 2 bull bars, doji, 2 bull bars, doji. It wasn't really that strong, and this was strong enough for at least a second leg. And but what we can see is, the sell-off, the retest of this close and this low were weak. 3 bear bars, but tails on the bottom, bad follow through. Tails down here, dojis. It just really wasn't that strong. And then even the rally up here, again, it's not that strong. So I hope that example was helpful. And so real quick, let's look at Friday's price action real quick. I don't think I talked about it, so let's give a few minutes on that. So on the open of Friday, if you listen to my Thursday video, I said that this close is a problem for the bulls. The bulls couldn't close on their high. Trading range price action, we fell below support, turned up. Bulls got a weak close, couldn't close on the high. So my thought was we're going to get bad follow through. And I'm pretty sure I said it. I'm almost positive I said it. That on Friday we may gap up or we may rally, but we're going to get something disappointing. A doji bar, a bear bar, something bad for the bulls and good for the bears. And this is what we got. So more trading range price action. So real quick for the mini, we opened, we tried to break above this high over here, which looks like that's Wednesday's high. Yeah, so we're trying to break above up here. We have an obvious target, yesterday's high over here. So when we opened up, tail on up, we went 1 tick above this high and sold off. I figured probably sellers above, and we'll probably get a swing down at some point. But it took over an hour before we got the swing down. So if we notice, look over here, stop entry bulls who bought 39.25 got exactly 10 ticks for a 2-point scalp. 35 was their entry. I'm sorry, 39.5 was their entry. Price went 9 ticks higher and let them out with 2 points. Same thing if they bought this high, and then it started trapping them. So bulls are scalping, and bears are probably initiating swings on the downside. So plenty of traders will, they'll sell here, sell more below here, and use a wide stop and bet that we get down to here. It's kind of one of those, so maybe you sell this high, put a target here, and your stop up here. Well, it's basically a 1-to-1 risk. It's basically a 1-to-1 risk reward, and the math's pretty good. Again, I'm talking softly because it's late at night, and just trying to keep my voice down. And as you can see, bulls had one chance to get out, then we sold off. Over here, this sell-off's kind of one of those 90% sell-offs. This breakout right here, there's a 90% chance, 80%, 90% that we're going to get some sort of measured move down. Maybe above this bar, maybe this close, probably not that close, but for sure this high to this close, projecting down here. And it's different from here. One of the problems with stair-stepping patterns is that where did the breakout happen? Here, maybe here. Let's just say we'll say here. Well, again, probably a 60% chance that of some sort of measured move from this low to probably this close, maybe even this close. 60 to 90, sorry, 80-ish% chance, somewhere around there, that we'll get a measured move up. Maybe even all the way up here, which we ended up getting. However, when we get a breakout, pull back, and then another breakout, pull back, and another breakout, the probability starts going down with each breakout. So it's much more difficult. In other words, it's a strong trend, but it's going to run out of steam. The problem is the market's exhausting itself rather quickly, And now, with that said, it's not exhausting itself enough to get something drastic. A sell-off that's drastic, because we're breaking out sideways, breaking out sideways, breaking out sideways. So it's more likely to just, at some point, the move stop and go, sideways into the close, maybe go a little down, but probably not a sharp reversal. Anyways, here, strong enough breakout, so we probably a spike, channel, top of the channel, maybe the end of the spike, or end of the pullback, or start of the pullback here. Broke above, sold off. This is kind of, a similar version of this, and it's basically why wedges reverse. Here's a breakout, maybe, again, same thing, maybe 60% chance we get a breakout, maybe a measured move up of that, maybe. Not really a great breakout. But we broke to the upside, sideways, another breakout, bad follow through, another breakout. When you get these breakouts and bad follow through, it's a sign of trading range price action. So that means it'll entice the bears to use a wide stop up here and sell. So maybe bears sell here, stop up here, and then they sell a 50% pullback of maybe this whole move. So bears sell this low, sell more, 50% pullback, maybe below this bar, get out of break even. A lot of traders did that and pulled back. So I hope I'm making myself clear. Trading range day, traders will scale in. I hope that scaling video, or this scaling video, and that example kind of helps clarify of why it's important to be able to trade small. So I hope this helps. Let me know if you have any questions. Thanks.